Um, okay, thanks everybody for joining. Happy end of July. Um, I guess the first order of business is to see if there are any issues, comments, or concerns relative to the minutes of our last meeting.
No concern?
For me.
Okay, great. Uh, so, Dale, why don't I turn it over to you to introduce our friends and guests at Cook Street?
Do we need a vote?
Yeah, I'll move to approve the minutes if that
All
helps.
right,
Second.
all in favor?
Aye.
Aye.
Okay, thank you.
Okay, so, yeah, Cook Street, you know them well. There were some comments on the investment report that I forwarded to Dana and Stuart, and they were more than willing to oblige in making some adjustments to the report. Send out an adjusted report that you should have all received, and I'll turn it over to Dana to go through the report.
Great.
Perfect. I'll just give this a second to make sure everyone can see my screen.
Yeah,
Yes.
we can say
Okay.
that.
Okay, well, our first quick update is not an exciting one, but that is that your team has been referring to us as Cook Street for the last couple of years. We are now rebranding as the Fiduciary Consulting Group at Morgan Stanley. And a big reason for that is just, you know Morgan Stanley, you work with Morgan Stanley, the naming Cook Street probably didn't have as much of a meaning to you, but everything we're doing is exactly the same, and hopefully it calls out the fact that we are fiduciary consultants. So let us know if you have any questions, but over time you'll see our email addresses change. So that was just a quick update for your team.
Hey,
I hope that comes with a comp increase for you guys.
Thank you. Thank you.
I'm sorry.
No, go ahead, Michael. Sorry.
Does that mean you are an affiliate of Morgan Stanley or just related to them through a contractual relationship?
So we are fully owned by Morgan Stanley. Stuart and I are Morgan Stanley employees, and we really have been since we've been working with you. It's just that our name change over time has kind of been integrated more into the Morgan Stanley branding.
Great, thank you.
Wholly owned by Morgan Stanley. Okay, well, today we have several additional topics, and we want to make sure to reserve a little bit of time for them. We really appreciate your team's feedback and input on our reporting, so please keep those coming our way. We'll keep updating and making these materials more useful for you. Before I dive into our executive summary and walk through portfolio performance, I actually think it's really important, given the volatility in the markets, that we get a quick recap of what has happened in the broader equity and fixed income markets over the last really 6 months. So I'm going to turn it over to Stuart just to cover 2 quick pages from our market review before we dive into your portfolio.
Yeah, and then since we last spoke, I mean, it feels like in the last 3 or 4 months, from a financial market perspective, we've lived a couple of years worth of market-related items over a relatively short-term period of time. And it's important because it helps inform the trajectory of performance here over the last calendar quarter and even so far through the first month of calendar Q3. Recall the last time that we spoke, we were at somewhat of a nadir from a market perspective, as well as from a general macroeconomic perspective as well. When we met back in April, from a higher level, broader macroeconomic perspective, we always start here. That's based upon a belief that while anything can drive markets day by day or quarter by quarter, whether it's policy activity, geopolitical conflicts, weather-related events, tweets, anything can drive the markets in the short term. We genuinely believe that over medium and long-term time horizons, underlying economic and business fundamentals will drive outcomes within financial markets. Where were we, or where are we today? Well, first, from a macroeconomic perspective, and this came, I think, yesterday afternoon. It's not encapsulated in this report, although we can update it for your all's records. The first estimate for Q2 GDP came in at around 3% annualized growth. So a reversal from the decline in GDP that we saw in calendar Q1. Recall in calendar Q1, a lot of companies were bringing forward imports ahead of concerns and uncertainty over what forward-looking trade policy was going to be here in the US. That bringing forward of imports, as well as some reticence from consumers and businesses in terms of spending, led to an absolute decline in economic activity in calendar Q1. We saw that reverse in this first estimate that was produced yesterday afternoon by the Bureau of Economic Analysis at 3% annualized. So a lot of noise in the first two calendar quarters. There is expectations of positive growth now over the remaining portion of this calendar year, although those estimates are fairly wide amongst economists and market participants. But certainly more level footing, I think, generally speaking, than where we were back in April in terms of expectations for economic growth. Part of that is underpinned by the fact that from a labor market perspective, labor markets remain relatively tight. We've stayed in a tight range of unemployment somewhere in between 4 and 4.2, 4.3% now for the last 12 plus months. It's a little bit higher than what it was 18, 24 months ago, but relative to long-term historical averages, overall levels of unemployment remain very low. And overall levels of wage growth continue to outpace inflation. So wage growth has been running typically in between 4 and 5%. It's come in a little bit here in the last handful of months, but that's generally been ahead of overall levels of inflation, which has been positive. And it's helped sustain underlying momentum in the broader macroeconomy. From an inflation perspective, the June figure started to peak up a little bit. Now we were running in between 2 and 2.5% over the first half of this year, generally speaking. That number came up to 2.7 with the most recent reading that came out a couple of weeks ago. Some other preferred measures of inflation, I think one came out this morning a little bit higher as well. There's uncertainty as it relates to the impact of trade policy, fiscal policy, et cetera, on forward price levels. Although the Fed and others have, I think, more or less centered expectations for the remaining portion of this year of inflation somewhere in between 2.5 and 3.5%. Obviously, we'll see what that looks like here over the next handful of months. But kind of worst case outcomes as it relates to trade have abated somewhat as market participants have digested kind of the cadence of policy prescription from the administration and then how that's led to subsequent negotiations in terms of trade policy. So a lot of digestion of data and events here over the last handful of months. The economy is probably on a slightly more even footing than what it was the last time that we spoke in April. It led to a very strong reversal in markets in calendar Q2. And most of you already know this, either in your work or in looking at portfolios that you oversee. Large cap stocks up 11% in calendar Q2. Small cap stocks up another 8 to 9%. International stocks, which outperformed in Q1, had another really strong quarter in calendar Q2. Fixed income markets were uneven. The yield curve steepened. We won't show that page, but the yield curve steepened. Longer term rates went up. Shorter term rates went down. There's still concern over the sustainability of U.S. government debt. So that led to some areas of the broader fixed income market underperforming. Areas within credit, though, tended to do well as credit spreads came in a little bit. More rate-sensitive sectors within the stock market, utilities, global real estate, other areas that tend to be more heavily indebted, underperformed the broader market. Although I'll say, even real estate still up 4 to 5% over the quarter. It was a good quarter, just underperformed the broad rally that we saw in calendar Q2. Last thing I'll highlight before we get to the portfolio, just to put a finer point on how dramatic the recovery was here over this quarter. We put together this chart which just highlights the manner and the velocity of the V-shaped recovery that we saw between the first couple of weeks in April and the remaining portion of calendar Q2. So between mid to late February and the first part of April, we saw large cap and small cap US stocks decline by more than 20%. So a very steep sell-off over a relatively short-term period of time. Somewhat remarkable, we've seen markets essentially completely erase the losses that we saw back over the last handful of weeks of Q1 and the first couple of weeks of Q2. For large cap stocks, now positive 6-7% year to date. Smaller cap stocks have lagged a little bit, but again, markets experience volatility in every calendar year. We highlighted that last quarter when we spoke. This level of trough and recovery over a short-term period is something that you don't typically see that often. We saw it to some degree during the COVID period, but even if you look back at like the great financial crisis or in the tech bubble, the recovery of stocks was much longer than what we experienced here over this past calendar quarter. So fairly extraordinary market recovery, something worth highlighting given everything that's happening.
Any questions there? I think hopefully this page in our market update sets the backdrop for your portfolio returns, which jumping to the chase, were very good in the second quarter. Your portfolio is weighted towards fixed income, right? 60% fixed income, 40% equities. Over the last 12 months, fixed income has done very well, right? In general, up 6% over the last 12 months. Equities have done significantly better as over the long term you would expect, but that's a pretty big difference between the S&P 500 and between fixed income. And it kind of tees up to the benchmarks we're using and the discussion around when we show an IPS benchmark, what does that mean? And what are we tracking against? So with that, I will jump
Sorry,
back.
could I ask a question, please?
Please.
Seeing as you offered.
Yeah.
It's Larry. Hi. With the dollar weakening significantly, it's now just recently strengthened, but what are your concerns about currency impact on inflation and your outlook for inflation in general?
Yeah. So I would say that the house view on inflation tends to be more or less in line with general economists' expectations as well as the Fed's expectation that weakening US dollar, as well as any type of tariff regime, should have an upward impact on price levels and should more than offset declines in demand for products and services from whether it's US consumers or global consumers. That balance of the deflationary aspects of just less spending versus
Sure.
the inflationary aspects of declining US dollar, as well as whatever the tariff regime looks like across various bilateral or multilateral partnerships, likely is to lead to an increase in price levels. I think that the expectation on the increase in price levels has come down within our own organization, as well as more generally speaking here over the last, call it 3 to 6 months, as I think our organization as well as others have gotten a better sense of what the objectives are of the Trump administration's negotiations in trade policy. It's why, though, that within this portfolio, as well as any portfolio that we're overseeing, we want to have a good amount of exposure, relatively speaking, in international equities. They've been an asset class that has underperformed broadly here over the last 10 or 15 years. And we have a chart in here that highlights that. We don't need to go to it, Dana, but we genuinely believe that a broadly diversified global equity portfolio should have exposure in international markets, both in developed markets and in emerging markets. And to that end, whether it's a portfolio like this or if you're a 401k plan investor, having exposure to international markets has been very additive here over the first couple of quarters of this year, not just because local returns have been strong in international markets, but as U.S. domiciled investors, having exposure in international markets when the dollar is declining is also an added boost.
Sure. Yeah. Okay. Thank you.
I think that was good context for the reserve fund and the benchmark and kind of the targets we have set in place. So today we do want to spend a few minutes going through what we call a portfolio asset allocation analysis. And what that is once a year, we like to come back to the targets, the target weightings between equity and fixed income that your team has put in place in your investment policy statement. And those are the guardrails with which we work in. So we wanted to come back and say, like, what's our forward-looking view on your current asset allocation? Where would we expect returns and risk levels to be? So we'll spend a few minutes there. In short, we actually think, given the fact that your reserve fund, the goal of it is to really outpace inflation and construction inflation. And the latest figure that you have and that's embedded within your reserve study is 4.9%. We actually think a 40% exposure to equities, is reasonable and actually gives you just a little bit of cushion to still meet that level of expected inflation. So what has that done? Within the reserve fund itself, we ended the second quarter with $25 million in assets. And again, right now, the house view at Morgan Stanley is basically equal weight equity targets. So we have a 40% equity target. We are right there at 40% equity within the reserve fund portfolio. During the second quarter, that exposure to equity was very advantageous. If you remember when we met last quarter, during the first quarter, your portfolio was slightly positive, but under 1% positive returns, right? Kind of flat to positive. In the second quarter, your portfolio generated 4.8% returns during the 3-month period. When you look at, what drove that, Stuart just reviewed it within the market review, right? It was that exposure to risk assets. Over the last 12 months within the portfolio, and this was a really good suggestion from Dave, let's add the trailing 12-month view to this report going forward. Your portfolio has generated a net of fee performance of 8.8%. So certainly when you look, and since inception, we include one more data point, since you've hired us to oversee the portfolio, 8.6% annual. So certainly we're very pleased with the fact that this portfolio is outpacing inflation. And in our view, it's doing so in a very kind of risk-controlled fashion. And we can talk about some of those risk controls. Paul had some good questions around the fixed income portfolio. So we've included some stats in here around scenarios on what would happen in various rate and credit spread regimes. But in general, very pleased. So a question that came up, several questions that came up is, well, when we show this against an IPS benchmark, right? If you look at the last 12 months, the IPS benchmark, we say, was up 10.1%. So at that point, what is driving the underperformance versus benchmark? Now, wanted to take a step back and review the investment policy statement itself. And what is that benchmark? That benchmark, the 10.1%, is actually embedded within your investment policy statement based on the targets and the guidelines you've provided us. So we are targeting at Morgan Stanley 40% equity, 30% of the 40% domestic US equities, with that 10% exposure to international. And Stuart just mentioned, our view on international as a good diversifying asset class within the equity space. On the fixed income side, the target 60%. So that is where we sit today, equal weight equities. You've given us a little bit of leeway around these targets to make minor shifts up and down where we see appropriate. 6 months ago, we were slightly underweight equities, right? We were underweight by a couple percent. So when you look at the trailing 12-month return, that underweight equity, we had less than 40%, has been the key detractor in the portfolio versus benchmark. right? Equities have over the trailing 12 months and since we've been hired to work with you have done incredibly well and have far outpaced fixed income. And because our IPS benchmarks use three very kind of high level, simple underlying indexes that are weighted based on your targets, your overall center targets, that is what's driving that minor, the underperformance over the trailing 12 months. In the most recent quarter, I'll pause there. Does the benchmark make sense? We added this to a footnote on the page. So we're benchmarking the US equities to the Russell 3000, broad-based US equity benchmark. We're benchmarking the 10% equities to the ACWI ex-US index. And then your fixed income, we are using that very standard Bloomberg US aggregate bond index. I want to pause to make sure we did add that because I think it's helpful to pull that forward as a footnote here. But does the benchmark itself in terms of the construct make sense and what is driving the 10.1%?
Forgive the ignorance though. The Russell 3000 is, how does that compare in structure or nature compared to the S&P 500?
Yeah.
It's oh, go ahead, Stuart.
Yeah, it's a good question, Larry. It's the Russell 3000 is an all cap benchmark, so it includes large, mid, and small cap U.S. companies.
Yeah.
Whereas the S&P 500, think of it as probably 90% large cap, 10% mid cap or so. The Russell 3000 generally as a construct is a 70-20-10 portfolio, 70% large cap, 20% in mid cap securities, 10% in small cap. So relative to the S&P 500, it's going to have a small bias to small and mid cap equities, but is generally intended to be representative of the overall market capitalization and that balance of smaller and larger companies in the US.
Okay. So, I mean, the small caps haven't been doing that well. I think recently they're up and down, but does that drive your investment policy, the benchmark, or not? I.e., do we have X% more in typical Russell companies than S&P companies?
I think I had a similar question. It's basically, how do you correlate your actual investment to the benchmark, right? In other words, your benchmark is your benchmark, and then you're making investments, and your goal is to try to meet or exceed the benchmark. So in your strategy around making investment, how much does the benchmark drive where you make your investments? Because in a simplistic case, you could simply invest in the benchmark, right, and achieve the benchmark returns, if that makes sense. So I'm just curious, how do you think about correlating where you actually place investments against the benchmark that we're using? And clearly, the level of correlation can drive differences in benchmark returns versus actual returns as well, right?
Yeah. So two good questions. The short answer, and maybe we can go to the holdings page, Dana, just to illustrate this. The selection of the benchmark index for the IPS absolutely correlates to the underlying holdings that we will have within this portfolio or any portfolio that we manage, of how that maps to your current portfolio. I would say that it is extremely rare that we find investment policy statements for portfolios like this, or really any portfolio, to not be like broad-based and cover something like a Russell 3000. Said a different way, it's unusual. I don't know of an instance where we have a portfolio where just the S&P 500 is utilized as the benchmark for U.S. equity. Certainly, that would be fine if a client wanted to do that. It would impact how we would invest from a risk perspective. Relative to the Russell 3000, this is how we're allocated today within the U.S. equity market. So the way to look at the slide, so excluding the bottom two rows, which just highlight our international developed exposure, anywhere from that international equity rows and up highlights our balance of actively managed and passively managed investments in the US. If I were to summarize it, I would say that it's intended to be broadly diversified amongst actively managed and passively managed vehicles, particularly within the large cap space, where typically the market's a little bit more efficient than what you might see in mid and small cap. But we do have some passive exposure in mid and small cap as well. So a range of different value and growth exposures. They're kind of top half the page. And then in those two kind of rows there in the middle portion of the page under US mid cap and US small cap, we have two portfolios. We have an actively managed portfolio by Earnest Partners, and then we have an ETF as well that we utilize. If we used a benchmark of just the S&P 500 as an example, I think we would still have some exposure in mid and small cap, but it would be less because we would want to balance the overall risk profile relative to what we're trying to outperform, if that makes sense. It
I'm good.
absolutely impacts it.
I'm good, thank you.
Okay, so I had a big picture question for the Morgan Stanley guys. If you were looking at a clean piece of paper and someone came to you and said, look, we want to invest $25 million with you, and our objective is to beat in the construction inflation rate, what would be the mix of equity and debt that you would suggest to accomplish that goal?
Maybe to answer that, we can go back to section 6 of this document. So, Paul, to your question specifically, we updated our capital market assumptions at the end of May, beginning of June, and have run those figures for your all's portfolio. The way to read this page going left to right, we have your current portfolio targets, that 40-60 mix there, that first column that Dana is circling. And then as you go across the page, we looked at a portfolio that's 50% in equity, 50% in fixed income, as well as one that's 30% in equity, 70% in fixed income. That first row below there is highlighting our expected annualized returns for those three portfolios.
Right.
It does not have any expectation of like alpha from active managers. This is essentially just here's what we think the market's going to give us for those three different types of portfolios. So essentially a range of returns somewhere 5.5% for a 30-70 portfolio, and then 6.5% for a 50-50 portfolio. So the point that Dana was referencing earlier, when we saw the 4.9% in the reserve study and line that up against the current portfolio, we think it's going to earn about 6% or so. We felt that the current portfolio as it's constructed today isn't taking too much risk relative to that 4.9% target. Gives us a little bit of a buffer over that target. You know, could you have 30% in equity and be closer to that target and take down risk a little bit? Absolutely. It's probably the balance of art and science on this is how much of a buffer do you want around the target itself, but nothing out of line from our perspective in terms of where the portfolio stands today relative to that new reserve study that came out.
Okay. All right. Well, we won't dwell on that. As long as you're on that page, can the Sharpe ratio numbers on this page be correct? They don't look correct to me.
Yeah, we've confirmed it, Paul.
Because I mean, generally speaking, you want a Sharpe ratio to be at least 1, right?
Oh, no. Generally speaking, so there are different measures like, and not, I don't mean to get into the weeds. There are different measures like information ratio and others that you tend to want to see around 1, but Sharpe ratios don't tend to be as high as 1. At least not what we've seen, you know, historically for like long-term portfolios. I mean, in the short term, they can be higher than 1, but rarely in the long term would you expect a Sharpe ratio to be above 1. That would be very unusual.
All right, well, I don't want to distract the stream here, but those numbers looked unusually low to me. Anyway, let's keep going.
So just so people know, Sharpe ratio sort of measures the efficiency of your return relative to the risk taken, I think. Is
Right.
that-
Yeah.
Okay. All right. All right.
Yeah, I mean,
we can
usually
move on.
usually
We
the
can-
only four. Oh, sorry. Go ahead, Dave. Sorry. Dave.
I was just gonna say we can move on. I didn't mean to take us back.
Let's keep going, guys.
Well, so this was essentially what we wanted to review on the asset allocation side, is that is exactly this, that relative to a roughly 5%, right, inflation target, you do have a little bit of cushion in the medium term view there, if this was a concern, but we view the 40% equity within the portfolio as to being very reasonable towards hitting the 5% return target.
So within the equity portion of the portfolio, would you anticipate for the coming quarter or the coming half year a change in the mix of equity? Or would you expect that the allocation that we see as of June 30 would stay more or less the same?
You know, I think a little bit more the latter, more the less the same. But just so, you know, you're aware, like we are making minor shifts within those bands that you've set for us throughout the quarter. Most recently, we've shifted a little bit away from value, more into like a core US equity exposure. And very minorly, we've shifted a little bit out of the small and mid cap space up into more of a large cap space. So those types of tweaks, and we're talking 1 to 2%, you know, moves in there. Those are the types of tweaks that our team is making on the go, but still holding within, you know, these targets and holding really close at this the target. Right now, the top of the house view at Morgan Stanley is equal weight US equity and equities in general.
Okay, that's fine. I just and maybe it's in here, Dana, but as we do our quarterly reports, to the extent that the composition, forget the overall percentage, but to the extent that the composition of the equity portfolio has shifted tactically or otherwise, it just would be good to highlight that.
That's an easy thing for us to call out. We can start bringing, we've been focusing on the broad allocation, right? And the broad allocation, quite frankly, has been what's driving most of the vast majority of returns, but kind of that sub allocation effect intra-quarter and intra-year, we can absolutely bring that to the forefront so that it sticks out on these front 2 pages.
All right, great, thank you.
All right, a final question. Sorry, I just thought of something else. How much of our 25 million is invested with the big 7? Magnificent 7, roughly. Is it 5%, 100%?
Let us take that away, Larry. I don't have the exact percentage in front of me, but we can pull that relatively quickly and we're going to report back to the group.
Okay, and is that an issue? You know, say if it's 10%.
Well, generally speaking, so like if we went back 12 or 18 months, we were more underweight that cohort of companies. Recall at one point too, we've talked about this a little bit. We had an equal weight ETF, S&P 500 ETF within the portfolio that directly was underweighting because of its construction methodology. Those companies, we've taken down that underweight, so we're less underweight that cohort of companies today than what we were 12 or 18 months ago. But I can get the exact percentage of like where we're at.
We're still underweight, which I think is probably good. Is that correct?
Yeah, we're still underweight, just not as underweight as what we were.
No, okay, good. Okay, so at least we can, okay, we're underweight, good.
Can we go back to that previous slide real quick? I just have one other question, the comparison of the composition. asset composition?
Certainly the slide with the managers, the underlying manager detail.
No, the one that, the pie charts with the 70, 30, 50, or 60, 40, 50, 50.
Oh, yes. Sorry to make you dizzy while I get there.
So, and I'm not an expert at this, but I'm curious, there's not much deviation really when you think about, standard deviation, there's pretty much, but when you look at probability of positive return or even annual yields, in Sharpe ratios, it's just interesting that 60-40 versus 60-40, versus 70-30, there's not that much differentiation across those three in terms of those metrics. Is there a reason for that? I mean, obviously 70-30 versus 60-40 is not a big difference, maybe.
Yeah, I think you just hit the nail on the head. Like if we were to run scenarios that were more on the tail outside, you would see more deviation. I think where you see it play out more is if you look at rolling those expectations out 20 years. And that's what these bar charts do at the bottom, is if you were to take this out and compound it over 20 years within 2 standard deviations, what is the expected portfolio value in 2044, right?
Yeah.
All else equal. So that's where you'll see more deviation, right? You actually see a 10% deviation up and down in expected 50th percentile portfolio value.
Got it. Yeah. So it's the duration of the time frame that makes the difference.
Absolutely.
You see greater differentiation the longer the tenor of the analysis.
Exactly.
I would just highlight too that like with fixed income yields being meaningfully higher today than we're
Yeah, I think that's the difference, right?
more parity amongst various portfolios now than what we saw 3, 4, 5 years ago. Like if we were doing this analysis back prior to the rate increases in 2022, the differentiation between expected returns on a more fixed income heavy portfolio versus a more equity weighted heavy portfolio were much starker.
Right.
John, the other thing to keep in mind is our constituency, and which is to say our members. And to the extent that they are our shareholders here, they are ultimately the investors. The returns over 5 years or for 10 years or for over 20 years is obviously very important in terms of what the mission of this fund is, but this concept of drawdown is also very important. And if there is a meaningful drawdown, over 12, 18, 24 months, there's going to be a reaction that we just need to understand and be alert to. And so it's just an observation in terms of balancing our risk return. The long-term performance of this portfolio is the most important factor, but there are also dimensions associated with drawdown probabilities as well that we need to keep in mind.
Yeah.
Absolutely. And we do have, if you ever on your own reading want to look through, we do have, stats in here that show, if you were to increase equity by 10%, your value at risk or the kind of maximum expected 1-year portfolio loss goes up by 300,000. So within a given year, that's a fairly significant amount. But I think, I want to make sure, I know you guys have additional agenda items. The only other things that we had on here today were, we do have returns for the other kind of 2 buckets of cash-like portfolios that we're helping your team manage. And we work very closely with Dale and team in terms of when money is needed, liquidity, reinvesting in very secure treasury notes and treasury securities across these two buckets of money, about $5 million in each. And both have earned, decent returns, exactly where we'd expect given where rates are. So the general operating fund that has maturities due over the next really 6 to 7 months, you've earned a 4.3% annualized return since inception. And then for that designated cash fund, which can invest a little bit further out, I think right now we're sitting about 0 to 9 months in general in terms of maturities there. 4.47%. So you see a very slightly higher return there. So we keep track on that, but we work really closely with Dale on those pieces. And then the last thing that we did include, and we're happy to go there, but I know you guys have a lot of other agenda items, so we can take, Paul, we had run some scenarios on your fixed income portion of the portfolio just to show how sensitive is that 60% fixed income to changes in interest rates or changes in credit spreads. We're happy to spend a few minutes if you'd like to go there, or if you want to pump that for a future.
It's useful. And I saw it, and I think it's there because I want people to understand the market value sensitivity. I think if there was a significant move in interest rates, that could cost us $1 million. I forget the exact number, but there is real volatility at the long end of our fixed income portfolio, and so thank you for adding that. I had a couple of observations that I wanted to make before we let you guys go. Because because our objective here is unambiguous, stay ahead of construction inflation, I would like to see that metric more prominently visible throughout this report. So for example, on page 1, actually it's page 5, the executive summary, I don't think you can find the construction inflation index as a point of comparison. We say in subparagraph number 4, inception to date performance is 8.58. Okay, well, what was the annualized construction? So that is a point of reference that is going to be very meaningful for the committee, for the board, for our membership, because we're not running a hedge fund. We want to stay ahead of construction inflation to replace bridges and roads. That's what we're doing. So that was one point. Another point is really for Dale. So we have constructed a bond ladder for our fixed income portfolio, and I am not in any way challenging that ladder, but quickly maybe describe how that ladder was constructed.
Are you talking about within the operating?
No, no, in the reserve fund.
Yeah, that's all Cook Street. I don't manage that.
Yeah, so that portfolio, that portion, the fixing a portfolio in the reserve account, we've delegated to Sage as an investment manager, and I would think of it less like a bond ladder, Paul, more like a traditional fixed income portfolio that's trying to provide diversification away from the risks inherent within the equity portfolio. So whereas the operating and cash portfolios have very specific profiles to help Dale meet his cash flow needs and objectives, this portfolio with Sage, which Dana's gone to the aggregate look of it, is I would not characterize it as a ladder, more of just a diversified portfolio of fixed income instruments across a range of asset classes.
So I don't have the number in my head. Okay, here we go. So 54% of our fixed income portfolio has a maturity of over 10 years. Right?
Yes. So it is. Now, the one caveat there is that will include mortgage-backed securities as
Yeah,
well.
you really have to look at the effective duration.
Yeah,
Some of those, there's a heavy weighting into like prepayment, fixed income instruments that are subject to prepayment.
exactly. Yeah. So the actual risk associated with the fixed income portfolio on the long end, we would agree with David, more focus on what Dana's highlighted here. So in terms of bonds that we're getting interest rate risk from on the long end of the curve, think of that 13% as more representative of the risk profile of that portfolio relative to the 54%, since a big portion of that are mortgage-backed securities that don't carry anywhere near that kind of interest rate sensitivity. Just technically, they mature a ways out.
Okay, that is very helpful. What percent of our fixed income portfolio would be in mortgage-backed securities or similar instruments? Because it sounds like it might be significant.
Yeah, so we have the portfolio exposures here. So around 35% of the portfolio are in mortgage-backed securities. And then the balance there you see in treasury, other corporate securities. Relative to the benchmark index, that U.S. aggregate bond index, which is a representation of the investment grade universe to a large extent in the U.S., we are overweight residential mortgages, slightly overweight credit as well, and a little bit underweight traditional treasury bonds.
Okay. Okay. In the deck, you have the pie chart showing the ratings of the fixed income portfolio. Maybe you could go to that real quickly.
Paul, we actually took that out of this version. That was something we intended to do last quarter. So thank you for the feedback on that. Our standard, the pie chart reporting, there's a lot of securities that have split ratings, and our systems pull in not rated for that. So it's not really a meaningful figure. So what we think is more meaningful is Sage. They actually provide the breakdown on quality here. So on page 67, and this is the view that we, think is much more meaningful and what we'll focus on.
Would we be able to get that by asset class? I mean, I'm assuming.
I think so.
I'm just curious what
Yeah.
BAA, I mean, is that corporates, I assume?
Oh,
Yeah, it should be mostly corporates, but yeah, we'll ping Sage. We'll have them provide breakdowns
Okay,
of the various between
but
mortgages, treasuries, and corporates. Yeah.
okay, but hang on a second. I didn't realize that. It seems to me a little awkward to have the fixed income manager provide us their quality rating.
We can,
Well,
Paul. We'll get their definitions, but it'll be straightforward. They'll use the ratings provided by S&P, Moody's, etc.
those are
These
public
are not
ratings.
These are not internal proprietary ratings of Sage. These are third-party ratings. It's
So
just
in
an
a
aggregate.
situation where there's a split rating, you go to the lower.
We'll ask Sage, Dave. I'm not sure. I don't want to 100% confirm that. But yeah, they have a standard methodology they use for split rating situations where they use the lower or the higher. We can get that and report back.
Well,
All right, well, it's already
I
there.
guess
I mean,
I guess what I would say is we need to be very clear in our fixed income look through on the distribution of credit quality. And if there's subtlety there, or if it's counterintuitive, okay, fine. But we need to be very clear with our members what the quality rating that underlies our fixed income portfolio. And we need to use a standard that everyone will understand, not a hybrid, house derived, whatever. It needs to be very, very clear.
That's fair. We'll get those details. But just to be clear, it's not a house derived. They are using
So
standard.
can you go, I think you went through a slide that actually had the holdings and the ratings right there. So we could see where the BAAs are down there in that Bank of America variable.
Then why do we have the big NR?
Well, we took out that slide. It,
We took that out.
Paul, we had intended to take it out, and that was just an oversight, frankly, on our
But
part.
I don't want you to take it out. I just want the number, the pie pieces to be correct.
Yeah, we can. So I guess the question for you guys then, if we include that chart in there, which the reason we had taken it out is that because the system, for any time that it, like if there's a split rating and say that S&P's rating something, AA, and Moody's is rating it A, we thought it was more confusing that gets bucketed into NR versus
Well,
just
it was. We
including.
would agree with that.
I think the group
So-
decided either last meeting or meeting before that chart didn't make sense and
Yeah.
that's why you removed it. So I think it was the understanding of the committee that was going to be removed.
Mhm.
Well, let me just say that my interest is not to remove that the quality chart, but to have it be accurate. And if there are subtleties because if there is split rating, fine, let's agree that we'll use the lower of the two ratings.
Well, or you could show both. I guess you could show Moody's and S&P.
So we need to Dale, we need to get closure on this because this is a very big deal. Okay, the last thing I had, and this is for Dale. There is a slide on page 5 of 19 for the reserve portion of the report. It's a very good slide, very useful slide. If we could just go to that for a second. Right. So the second row under the bar chart says net contribution / withdrawals. Dale, why was there a 0 for the second quarter? Were there no CTRs in the second quarter?
Well, that's all run through our fund accounting process, and those are operating funds until such time that we've determined that there's a legitimate transfer from the operating fund to the reserve fund. And I will tell you that all those operating funds, any earnings off of those funds are allocated amongst the different funds based on the balances. So even though CTR money is housed in a operating fund account, the physical dollars are in a operating cash account. The earnings off of that are allocated back to the reserve fund based on the reserve fund balances in the general ledger. It's all part of the fund accounting process.
Okay.
So
All
I
right.
was kind of assuming that you only make those fund transfers at year end as you
Correct.
wind up. Is that
Correct. So
and that's what this reflects, that in the back periods you're just catching the year end fund accounting entries. Is that correct?
well, it's actually transferring. So for example, this year we're forecasting, I don't know off the top of my head, a certain surplus in the reserve fund. If that materializes and comes to reality, I'll transfer a good portion of that, if not all of it, from the the operating fund to the reserve fund, and then that gets incorporated into the reserve fund IPS managed resources at Morgan Stanley. But in the meantime, all the cash balances that are attributed to the reserve fund are, those earnings are being allocated to the reserve fund.
Okay. Maybe I could get a little more detail on that offline. I don't think we need to take the group's time on it. Okay, those are the items that I wanted to raise. Thank you.
Well, thank you. We have some good follow-ups in terms of enhancing some of these reports to make them more usable and friendly for this group. So we will follow up on those. But as always, don't hesitate to reach out to us in the meantime with questions. We appreciate your time today. Unless you have any other questions, we're happy to drop now. We'll take your lead.
Guys, thank you so much. We appreciate what you're doing for us here.
Thank you for your partnership. We
Thank you.
appreciate it.
Thanks, Dana, Stuart.
Cheers. Thank you all.
Bye.
Have a good rest of the week. Bye.
You want me to take it forward, Paul?
Yes, please.
So we changed the agenda a little bit. Michael has a hard out at 10:30. So we're going to move the internal controls discussion up to our next agenda item.
Oh,
Great.
thank you. Going to take it down. Please interject as you feel appropriate.
Sure.
So we had a meeting with our auditors who could also serve as our internal auditors to help us go through some internal control assessments. And you have a proposal in front of you. One of the things just to keep in mind, there are three different pieces or three different choices we could make. You know, small, medium, large, if you want to go to that extent. And obviously the fees are commensurate with the scope of services that we choose. When we take a step back, a lot of what we're trying to do here, yes, we have an audit. The audit does test our internal controls somewhat, but we wanted to actually look at something from a perspective of how do we get reliance to us, the board, and quite frankly, to our members, that the internal controls of our organization will help prevent fraud, discrepancies, that we're reporting accurate amounts and accurate dollars to our members. One of the things that we thought about is we could leverage off the ability of our auditors who do some internal control testing. They do enough internal control testing to deliver a clean, unqualified report, but we want to dig a little bit deeper. One of the things that, I know Paul had suggested and we've talked about is we've changed our controls on cash. So we've gone to, and I'm going to use this, and Dale, please correct me, more of a paperless way of delivering payments to our vendors. And we want to make sure that we've done that in the position that we have the appropriate sign-offs to our, to control the cash going out the door. Obviously, that's one of the things that all organizations do, and it's the thought process. How do we get this so that we give this good housekeeping seal of approval? Sorry, guys, the mailman's here. How do we get this good housekeeping seal of approval to our board and to our members that we're acting appropriately and that the controls are there to catch whatever it might be, whether it's internal fraud, which we don't want to think about, or quite frankly, from people and members outside of our community that kind of come in and say, let's wire $30,000 to us now for this vendor. So it's just a way of checking how we do things and how appropriate our controls are internally. Now, what we've done to leverage this is our auditors are going to be coming in during the first half of the year. So the thought process on this is to kind of push it after Dale and his team have, completed the audit. Obviously, the first half of the year, if you think about what we have to go for, we have to go budgeting. Now, then we go into, collection of the dues. Then we go into, the audit, and that's kind of our busy season. After the audit, leveraging what the auditors do, we would then think about bringing in the internal auditors, in this case, Christy Clemens, to work through a program that we all decide is the best fit for the organization. As you can see, and we would have them come in and explain the differences, but there are 3 different choices we can make depending on the scope that we would like to have for the internal audit. And the rest of it, they talk about KOSA, they talk about a bunch of different things that are all out there, and the framework in which they do this. And I will, take a step back and entertain questions that you may have on maybe the whys, the wherefores, and deferring to Paul and Dale on their thoughts as well.
Well, let me just say a couple of words, because I think this is an important topic. It's not an easy topic. But the first and most important thing that I would want to say, I think it may be intuitive. I hope it is obvious, but I'll say it anyway. The fact that we are considering this is not in any way a reflection or a concern about our staff. That's not what's happening here. We are and should be very proud of the fact that we've gotten 2 very clean audits over the last 2 years from a firm that I think we all believe is a very high quality firm. That's kudos to the staff. So this isn't about we're worried. However, as Michael alluded, we're dealing with a large organization, a large constituency, a lot of cash, and every 50 years or so, we ought to validate, and by means of an independent third party, that we have a control environment that will protect staff, protect the members, protect our capital, etc. And so to me, this is a good governance issue that high quality organizations do. And so I think this is something that we should explore. It has not been vetted by the board and would need to be vetted by the board, if for no other reason that it would be time consuming for staff and reasonable expense item. So what I'm looking for is input and thoughts from the finance committee as to whether there is consensus that this is something that we should. What we have now is a very preliminary sort of perspective based on the conversations that Dale and Mike have had with the 4 specialists. And my objective, if we can, is to develop a consensus within the committee and also, frankly, with staff, because I want staff to be comfortable that this is a sensible thing to do and a sensible use of member resources.
So if I may, I'd like to add just some perspective with regard to kind of the internal control environment as it exists and how we've gotten here, and then kind of what the 3 proposals mean to me anyway. As you know, we went through a pretty significant update to the financial controls manual last year, leading into this year's approval. As a part of that, the finance controls manual and all of our SOPs were reviewed to whatever extent you did individually, by the finance committee. And the effort there was to ensure that, one, there's transparency, but also get your view that the procedures in place established an internal control environment that was appropriate and all-encompassing, so to speak. And first and foremost, to give the finance committee at a minimum a comfort level that we are where we should be, so to speak. With regard to the proposal, the first option, or the first level, so to speak, is, in my opinion, what we are already doing with our auditors. It's just a review of the internal control environment, and making an assessment with a memo. It's not a report, it's not an opinion, it's a memo that states, hey, we read these through, and here's some thoughts, so to speak. And we've already had our auditors do that. Level 2 is, to a certain extent, one step further, in that it takes what they call a test of one, and they take each of the controls and they see it through from start to finish of that control for one item. And so they can see it in action, they can clarify what the control actually is and how we're implementing it. And then they come back and provide us with their thoughts. They also flow chart all of the internal controls, which may or may not be real productive or helpful to us. It's another way of basically looking at the internal control narratives. Sure, it might help us point out gaps, and it might help us or them point out gaps or understand the flow better, but not necessarily any further down the line with regard to these controls are sufficient and pertinent, and they're following those procedures. There's no assessment with regard to compliance and execution. And then the third option is basically the full step, in that they're, depending on the control, if it's a control that's executed once a year, quarterly, monthly, weekly, what have you, they will go in and set the number of tests based on that. So an annual might be 1 test or 2 tests, a quarterly might be 3 to 5, and so forth and so on, so that they get a real gauge of not only are the controls appropriate, but how are we executing and complying with those controls. In my orientation, number 3 is, if depending on what the finance committee and board, what their intent is, if they really do want to look at compliance with the internal controls, are we executing as we say we are, that type of thing, then I'd say number 3 is our only option. And with that being said, it's, and I think Paul probably alluded to it, we need to make sure that our definition and our scope is honed in so that we accomplish what we set out to do.
And I will tell you, Dale, because I will have to run, but I will agree with you completely. I think one of the things we would like to do, and certainly I would take that on with Dale and me, is to go back to 4 of us and say, can you do something on the fees and leverage off what you're doing with the audit? Basically timing, moving to a non-busy time of the year. I mean, the fees are high. It would be a budgeted amount we have to get in there. But is there a way we can leverage off it? I think the first one is almost a non-existent choice with us. We've got the audit to take care of that. The second one is kind of a stair-step approach to getting to the third piece anyways, which I think is where we would like to go as a committee, as a board, and an organization.
So if I'm looking at the slide that shows level 1, level 2, level 3, that's what we're saying.
Mm-hmm.
And I think
Yes.
what I just heard you say is that level 1 is pretty much what the audit already covers. Is that?
I would say yes. We don't get a firm opinion necessarily. It's embedded in the audit opinion itself.
But their work would include kind of what's in the scope
Yes.
of level one.
Yep.
Can I ask
So
a
really,
couple
we
questions?
would be choosing between level 2 and 3.
Yep.
And what you're saying, Dale, again, depending on what we want, which we need to better refine. That's the decision is really 22 to 27, 36 to 45 in terms of cost. And then does this set us up for any future annual activity, or could we just, is this a one-time sort of an analysis? Obviously, they may have recommendations for improvements, but there's nothing from a best practice standpoint, the frequency in which we kind of carry this out. Is there anything we're signing up for beyond just the upfront pricing that's shown here?
I think it becomes what the committee wants to do. This needn't be an annual event.
Yeah.
However, if there are, in my view, if there are substantial or substantive changes to what we're doing through the SOPs, I think maybe then you want to look at some form of a recurrence, recurring, not annual, but just when we make changes the way we've done.
And I think I would add that, this is kind of a threshold issue for us as an organization. And I'd like us to move forward and understand having actually done something along the lines of this proposal, then we have something concrete and have a much better idea of the value proposition. Was it helpful? Was it constructive? Do we want to do it on a episodic basis? Do we want to do it every 5 years? Do we want to, we can decide that, John's question, which is a good one, but I think we're gonna learn a lot more if we agree that some level of engagement along these lines is appropriate.
Do we have any existing sort of flow charts and, control descriptions, or would that be helpful to the staff to have? Part of this is obviously augmenting work that potentially internally we don't have the resources or the time to do. So is there, having mapped out control processes or control descriptions and all that stuff, is that beneficial to you? I mean, I'm assuming
We have all the standard operating procedures that we shared with the committee.
Yeah.
And we're updating them as we're always looking for improvements and efficiencies and effectiveness, both on the internal control side and with regard to procedures in implementation. So we're updating them as we go.
Well, that's the reason I asked, right?
So
like if they're replicating something we already have, or taking it and turning it into something that, or maybe there's an opportunity to say that portion of level 3. I mean, it's not a lot of money, so I don't want to nitpick here, but it's more like if you already have control documentation, they could review it and say, yeah, we think it makes sense, but we don't need them. We don't need to pay them to replicate what we already have. That was my question.
So they're not generating anything new.
Yeah,
They're looking at
testing
what we already have in place and making an assessment as to its appropriateness and completeness. I'll reemphasize, we will do whatever the finance committee and board directs us to do and guides us to do with no hesitation. With what the audit already does, they review all of our SOPs, including the financial controls manual. They make an assessment based on that test, because when they do sample testing of our procedures, that's a guide to them to how deep they go into their actual audit.
Right.
If they find something that they don't like with regard to compliance, they'll test more so that they can get another feeling of exactly what's going on and how they conduct their audit. So I guess for any of the assessment on these proposals, again, I'd like to say that one or two they don't make sense to me at all. To me, if the intent is to determine that the internal controls that are in place are appropriate, complete, it's a good internal control environment, that's one thing. If then it's a step further to say we are in compliance with those procedures, then number 3 is the only option. And I feel like the audit provides the other 2 options. In other words, they're already looking in, and I've already weighed in without an official opinion or report that we have no issues with your internal controls. We feel that they are sufficient, and I've asked from them to provide me with any comments or enhancements that we could do, and we're fine. They look good from our perspective, from an audit perspective. We're good to go. So to me, the big piece is that compliance piece, and if that's the direction, then great. We just need to fine tune it. I'll also say that because we had a clean opinion, you know, the auditors, they will provide management comments with regard to concerns throughout the audit, whether that be internal control concerns, what have you. And we've had none. So I guess it's an indication that maybe it's a base level. It's a foundation that says internal control environment looks good. We have no comments. The audit is clean, and we'll issue our letter. So again, we'll do whatever our guidance is, our directive is, but that's just perspective. I want to make sure that we're not spending members' dollars towards something that isn't real targeted and serving a real purpose of the board and the finance committee.
No, that was exactly my question, right? Like, how much are we already, there's always this question of, well, the staff is doing things and somebody needs to look at what the staff's doing. The audit, in my opinion, to what you're saying, is already accomplishing level 1 and level 2.
I agree.
Okay, so that gets back to my question. Why would we pay them 36 to 45, which at the very top in scope says includes all level 2 activities? So if level 2, we're paying them 22 to 27, and we're saying that the audit effectively
they need to maintain, this group needs to maintain independence of the audit group.
No, okay.
In order to issue a report or opinion on this space. So my orientation
we are going to have
is
to pay for double work, effectively. Work by the auditor,
well,
and then an independent verification from a third
Can
party.
we get, I'm just curious, Larry, Mary Ann, what are your thoughts on this?
just real quick, just know that internal control piece, that option 3, is going much deeper
Than the audit. No, I get that.
So much more deeper than the
Okay.
audit. So
All right. Okay.
it's a lot more work than what the auditors would do. And I just want to be clear on that. They're doing sampling. They're
No, I understand.
limited sampling
Okay,
in the audit. The internal control piece would be much more comprehensive.
got it. Thanks.
Sorry,
Great.
Marianne. You have the floor.
No, I just wanted to hear from, the other folks.
I had raised my hand at the beginning because I did not see the proposal and I was going to ask if somebody could resend it. I think I've got the gist of it from what has been discussed. The only other question I have is from the perspective of the people who have dug deep into this a little bit. Are there particular transactions that you feel like are the most risky that you would want to focus on? Is there a way to sort of hone the focus so that you're isolating a few specific transactions that you think are risky?
I don't know, Mary. This is Mike, Marion. I'm going
Yep.
to the meeting, but
I know you're on your way out. Sorry.
so that's okay. What you're trying to figure out is there, and anything that's involving cash is a risky transaction
Yep.
in today's day and age. If you think about
Makes
what
sense.
KICA has to offer, it's really the management of cash, management of our assets. So you're going to want to look at those in particular. And I think what we would like to do is, as we move forward, is to really hone on the scope of services we're going to ask Forbes to do, how they're going to follow transactions, what's going to be the end result of the deliverable to us. We've set up a set of SOPs, and what this is designed to do is we've developed the SOPs. The SOPs are adequate for our audit purposes. Now we want to have somebody come in and say, we, KICA, Dale and team are following those SOPs. I think that's what we're really trying to get to as the end result from this whole endeavor. I think the highest priority is really cash and investments that we have to look to. Those are our two biggest pieces and our two biggest assets. And Dale, I'll defer to you on that. You live it day to day.
Yeah, just by looking at the financial statements, the revenue assessment collections, the day-to-day POS collections, those are by far the most prominent and highest percentage of our cash inflow, right? So I think that's probably a main area of concentration. And then expenditures, I think expenditure wise, it's just a cross section of the organization. Sure, there's some procedures with regard to, for example, following the FCM on contracts and bids and those types of things. Those are just by their nature probably important for the finance committee, the board, and the members to understand that we're following those procedures. So we can fine tune the concentration by looking through what our financial statements read.
So here's what I'd like to, we need to move on, but this is an important topic. What I'd like to suggest is that Mike and Dale and others who would like to participate in the work team process, go back to Forbes and get a little more specificity as to what would be involved, what we could do in terms of costing, what would be the time commitment on their side and on our side, and get something that is more concrete that we could come back to the full committee and discuss, debate and decide. This is not a decision topic today, not supposed to be, but I would like us as a group to come to a conclusion, at least a recommendation for the board with some degree of specificity as to cost and benefit.
I was asked for comments. I'll send out an email with my thoughts later on. Thank you. For the benefit of time.
All right, so Mike and Dale, are you good with
Yep.
taking the next step here?
Yes,
Sure.
we will. Yeah, perfect. Thank you.
All right, appreciate it.
Yeah.
Thanks.
All right,
I'll sign off now.
All right, thanks.
Michael. Marianne, I think I just inadvertently didn't have you on the email thread, so I will send you that proposal post haste.
And Dale, I don't think I got it. I'm not sure, but please send it to me as well. Thanks.
Okay, sure. So Q2 financials. Pretty straightforward. I think from my perspective, nothing alarming, but the takeaway might be that on the revenue side, we're performing well with regard to CTR and commercial access fees, which will offset any negative performance against budget that we might expect from the investment side. Both operating and reserve fund activities on the operational side are producing savings overall against budget, and all in all, bottom line positive impact that we expect out of the forecast and Obviously, we'll update that as we go and incorporate Q3 forecast into the budgeting process at the end of September. Just to go through the deck real quick, just to point out on page 5, the cash management page. I added the designated funds detail just to show kind of what comprises that designated fund balance at any given point. And you'll see that the deferred flood dollars that represents the unspent special assessment, that's been added to that. And, you know, obviously the earnings from this designated fund go directly to the reserve fund.
Dale, on that page, there is a row entitled Reserve Short-Term Investments, $900,000.
Right.
Could you just, in the future, include under managed by and governing policy?
Okay. If I move forward, the balance sheet, you'll see down in the bottom left, under the operating fund column, the $513 of deferred revenue. That's, again, the unspent dollars. We anticipated at the beginning of the year, at the end of last year, that would be a higher amount, but we had some change orders and such. But that is our final accounting for the special assessment. We spent, I believe, around $718,000 this year towards the flood mitigation. So that's the full outcome of that process. And then I will point out under the reserve fund accounts payable, that represents 487 of that is payment to Gulfstream in July, which was the final payment on the flood activities. I really don't, I feel like the rest of the narrative is pretty self-explanatory, and you know, I could go through in detail, but I'd rather kind of open it up to thoughts and comments from the group. If we can do that at this point.
Okay, Dale, it's Larry. So I sent in a couple of comments to you personally. Oh no, to everybody actually, I think, sorry. We can't see the report on the screen. Could we get pages 13 and 14 up, please?
Yep. Just looking for it.
Sure. Well, I'll talk while you do that. So this is a quarterly financial report. I mean, I'm a finance guy. I know what you've done with the cash statement is basically, well, I think I know what you've done with the cash flow. It's basically a P&L. It's not really a cash flow forecast because you're not taking into account cash movements per se. You're just replicating an income statement with an adjusting line on page 14 that brings us back to something called GAAP, which is a take it GAAP profit. So basically we're doing better than our forecast deficit income wise by 723. Let's go to 14. So basically, you know, you've got the GAAP net surplus deficit, okay, of 723,000 plus. So it's a good guy. So there's no real mention of profit anywhere on here. Now I know you've got the other line, which I presume is your adjustment for all the items above to get you to a profit number or a deficit number, but it doesn't jump out at me. I mean, this just jumps out at me. It's titled cash flow. It's not really a cash flow because you're not looking at year-end payments of receivables and payables and capex payments and things like that. I presume it's just a cash flow statement, but really it's a P&L statement, sort of encapsulated as a cash flow statement, if you see what I mean. Am I correct?
So this was a change in design that we, for all intents and purposes, agreed on and shared with the board.
I understand.
And it's simply a direction of establishing more on a cash basis and then reconciling back to GAAP. So
profit
as it pertains to accounts receivable,
it just says down here GAAP net surplus. I don't think people would understand necessarily, the reader on the street would understand what that means or what this entire thing means. It's not a cash flow forecast in my mind, not a proper one.
Wait, I'm sorry, Larry. I'm missing your point. Let's look at page 13 for a second.
Okay.
This is for the operating fund, not the reserve fund. This is a cash basis explanation of our sources and uses of cash.
Right.
Ending in, and the first column is year to date, and then Q1 and Q2 are full year forecasts.
Yep.
Compared to the annual budget.
Yep.
Which, okay. So what is your question?
So basically, I suspect that all of these movements, the variances, are in effect P&L variances, not cash flow statement variances. Like, you know, if I was doing a cash flow forecast, I'd say, okay, well, how's my capital spend phase now for the rest of the year? And how much am I going to have in payables at year end? And then adjust my cash flow accordingly. I may be overcomplicating things, but basically, I think with this, nowhere here does this talk about I would ask other members of the committee, what do they think this statement shows? I think it basically shows a P&L statement with no cash flow tweaking of payables and receivables at year end. And then if you look at the next page, Larry, then you look at the next page, it says GAAP net surplus deficit. It doesn't even mention the word, you know, income expense surplus deficit.
It's cash in and cash out.
But it's just a reconciliation to what we would produce on a GAAP level. You're right with regard to receivables and payables. It's not meant to be
it's not a cash flow test.
It's not meant to be an audit defined cash flow statement. It's at year end, we will introduce the changes in accounts receivable, accounts payable, but we're comparing to budget.
All right. Okay. I'll make my point. I'll just defer.
Forecast year end accounts receivable and accounts payable balances. So I guess what you'd say is, can I finish, Larry, please?
Sure, yeah.
I guess what you'd say is that this statement, in answer to your question, assumes no changes in accounts receivable, accounts payable throughout the period, but we will address that when we get to year end.
Okay. Well, for a start, please note that. And second, I would like, I just don't think this helps the reader, but that's my viewpould I don't know what the other members of the committee get out of this.
Let me ask you this question,
Larry.
Would we say that the negative 617 that is reflected in the budget, is that as close to a net income number as you can get, right?
Aside from the budget, yes.
Right. So to me, I think, Larry, if what you're caught up is, it says surplus deficit. I mean, I think it's effectively a proxy for net income in that it is taking into account depreciation and the other items that are, you know, migrating from the 1.342 to the negative 17, right?
Agreed. So, it's just what this conveys. That's all. And would the members benefit from this? And fine, they can benefit from it, but we need to get the wording right that, hey, it's not really a cash flow forecast. It doesn't look at receivables and payables and CapEx flows.
Well, yeah, most members don't know what that is either, right? Most members aren't going to appreciate balance sheet changes, you know, and how
Okay,
that could.
you've asked my comments. Those are the other comments on this particular thing. Then the second point, which is probably controversial, is I asked Dale yesterday where the 140,000 spend for the curbing or whatever you call it at Ocean Park is going, and it's going against reserves, and I question that.
Didn't we take that up in a previous committee?
Larry's comment was it's new spending, and why is it? His orientation is that it's new spending and shouldn't come out of reserve, I think is where
shouldn't come out.
That's what I said. Yeah.
Right. So this is Shannon. I'm not on camera, but I'm here. It was taken from reserve. It was by agreement of the board. It is an improvement to our road system that already exists in that area to stop the breakage of that asphalt. So it was seen as a reserve expense to existing assets. It's just an improvement related to existing assets. That was the decision.
Was it unanimous?
I believe so, but I'd have to go back and check the vote. I don't remember anyone dissenting.
Okay.
I certainly wouldn't have dissented.
Okay.
And Larry, just to be clear, in terms of your concern about page 13, I think our members do relate very directly to cash. This is not a traditional funds flow or working capital change report that you would see in a public company. I think our members care a lot about where the cash is going. We do provide a GAAP reconciliation, which is good and appropriate.
No, I understand.
But I think the change that we've made to show the members, the movements in and out of real money is what they want to see and need to see.
No, I agree totally. I just would like the word.
No, you asked what other members thought, and I was just giving you my view.
No, that's fine. Let other members speak then, please. And also about the 140,000 curbing issue.
Okay,
I'm
Dale,
sorry.
let's keep going. What else, Dale, on this report?
Well, I'm open to questions and comments. I'm happy to go into more detail, but felt that the report itself was fairly self-explanatory.
So Dale and I talked a little bit offline. Dale, as we stand here, the end of July, we have our Q2 forecast. If the forecast for the remainder of the year is wrong, what do you consider to be the most likely items, either inbound or outbound, that will change from what we have, what you show here as the Q2 forecast for the full year? What are the variables that you're sort of paying closest attention to?
All right, so it's hard to forecast contributions to reserves. It's hard to forecast to a certain extent commercial access fees, but I believe that the forecasts on both of those are intended to be conservative. On the expense side, you know, we're tracking quite well, and we've tracked quite well between the quarters and throughout the year. We've identified efficiencies with regard to how we are doing business within the operating department and forecasted those in Q2. So from my perspective, it's the revenue side, and the investment income is probably a nut. But again, the the investment side is hard to predict, but I think that what we do on the contributions to reserve and commercial access fees would more than counter any negative side of the investment to produce what we are looking for on the net side bottom line. Shannon, any thoughts on the expense side as far as questions?
Sure. So there's two big items contained within the expense side that are board related. 200,000 allowance was reserved for ARB if ARB comes online this year. 400,000 was related to amenities improvements if those come online this year. So that could be up to a $600,000 swing in expenses related to board decisions and what direction they go, or timing, particularly related to ARB control.
Yeah, I was curious about the improvements. I mean, I would have assumed we would have done more than 40,000 in year-to-date in the improvement number. Is there an accrual aspect of that?
Sure, I can talk to that.
Yeah.
The board has asked the amenities committee to weigh in on amenities improvements, and they've been working on that this year. They have used some of that money. I think it's.
Well, V-Gate, for example, that was done, right?
Yes.
Yeah.
Yes, that wasn't considered an amenity improvement for the
I got you.
membership. So the amenities committee was given 18,000, if I remember the number correctly, to do some preliminary conceptual design. And they are evaluating that now in order to make a recommendation to the board as to how to move ahead. So their August meeting is actually going to be their big list of things to try to determine their recommendation to the board of directors.
So in a way, depending on when that could get started, that's where you're saying there's a potential positive delta.
Correct.
On the 440.
There's a swing there.
Gotcha.
Yes.
But a negative delta on the 200, or is that a positive
So the 200
for the ARB?
That's still in discussion with the board of directors about timing. I would guess that it's going to be a positive swing. I just don't think we're going to stand up the full ARB by December. We may stand up portions of it, but I don't think we'll spend the full 200.
And remind me where ARB cost is in the line items. Is that?
It's under personnel. We kept it as a lump
So it's
sum.
all human resource costs.
We kept it as a lump sum,
Got
even if the board chose to spend, I don't know, I'm making numbers up, right? $50,000 for improvements related to technology or whatever.
Yeah.
We lump summed it all into personnel, so it was an easy number for Dale to recognize.
Shannon, in the reserve fund, are there any potential swing items that you would like to highlight? Page 22.
So there's probably a couple. Sandcastle is in there. I want to say it's just under $500,000. And Jody and Ryan are retooling the project related to the Sandcastle doors. That's going to be coming back to the board of directors because they've gained more information on how that repair can be effectively done. And we believe that that repair will come in lower than what is projected in here in the budget. The other swing would be related to street resurface. So we completed all of the roads for 2025 that we were scheduled to repave, and that came in lower, go team. So that came in lower than what we had budgeted for. So we expect that to be a positive variance.
So
Shannon, remind us, but me in particular, what is the Retz Bluff? Oh, was that the restroom facilities? What was the renovation there? Oh, what was the yeah, sorry, go ahead.
If I remember correctly, it's related to the dock and to do some dock repairs out there.
Yeah,
But that's off the top of my head, Paul.
Yeah. No,
Is Cinder Creek in the 440?
So Cinder Creek, God bless Cinder Creek. Cinder Creek dock is currently closed, but in positive news, we have received our federal, our state, and our ARB approvals for that project. It is out to bid now. Jody, the date is 22nd of August. So we hope to get that under construction this fall.
The cash of that will probably carry into the next year too.
It
right?
could, depending upon the timing of the contractor. But
That's great.
hopefully
Yeah,
not.
Hopefully you can get it done.
it took us so much longer to get permitting. Federal, state, and ARB were all slower than we expected.
Good.
So just to clarify on the building repair, sandcastle, and the street resurfacing, you can see those line items have already incorporated some of the savings, right? So we, for sandcastle repair, for example, we forecasted a what we consider conservative estimate of what that might look like. But I think there could be further savings if we don't meet that, right?
Mhm.
So.
Did that answer your question, Paul?
Yes, thank you. It looked, I thought it was an excellent report, and we seem to be on track, so I didn't have any major issues. Okay,
Agreed.
anything else for the good of the order?
I still have an issue over this curbing, I'm afraid. Shannon, can you show me where in our rules, covenants, whatever, it defines what the reserve is for, please? I tried to look this morning, but couldn't find it. So, my question is this legitimate take of reserves? Because it's basically new stuff. The town passed off on the construction, the roads and everything, and now we're spending more money on it. And not only that, are we taking it from reserves meant to replace existing material. So can you please show me, or later on send me an email saying where the rules about utilization of the MRR are? And in the meantime, I have to disagree with the treatment. I would like that minuted. Thank you.
Okay, but Larry, your disagreement is noted and will be minuted.
Great.
However, I don't want to ask Shannon or staff to do more work on this.
Okay.
Because while I respect your question, what you're saying is you disagree with the.
I don't know. I don't disagree. I don't know where the.
Larry, let me finish my sentence.
Okay, but you just said
what I believe you disagree with is the decision, the judgment that the board made, which is fine. I respect that, but that was the judgment. So I think the right recourse for you at the board meeting is to say, look, you guys spent X thousands of dollars on flat curbing for Ocean Park, and you took it out of the wrong account.
No, I don't know. I don't know whether it's been taken out of the account. I would like to see the rules and regulations so that I can form that judgment. But in the absence of anyone telling me,
the rules and regulations are online. Read the documents.
I tried to this morning before the meeting. If you don't want to help me in that quest, I will spend more time. I think Shannon must have looked at it already, so it's no additional work.
Okay.
So anyway, I don't understand.
All right. Anything else? Okay. Thank you all for your time and thoughts. A lot of important stuff. Thanks especially to our staff. They're doing a great job, and they're putting up with me and us. So thank you. And I guess the next meeting, among other things that may be important for us to talk about, will be the very front end of the budget cycle.
Correct.
Dale, any closing items from you?
No, I think we're moving in a positive direction, and I appreciate everybody's involvement and input, and we'll just keep rocking and rolling.
Thanks, guys.
Thank you.
Thanks, everybody.
Thanks very much.